Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. While we have been talking about the US exceptionalism, there is a major geopolitical issue which has been brewing. Iran's recent strikes against Israel as part of the retaliation for the Israeli attack on Iran's embassy in Syria. This has caused some moves in the financial markets, but let's understand more from JK. Morning, JK. We discussed US exceptionalism earlier. Now there seems to be an addition of geopolitical risk. How are you reading the overall situation? While will we see some more major moves in currencies? What do you think?
Good morning, Swaraj. Yeah, I think some push back into the U.S. Economy on the background as geopolitics took center stage on the weekend. There were talks of Iran's retaliation happening after the attack on their embassy in Syria was reported and resulted in some casualties, and that was reflected in oil price movement and then gold movement also, as we were into the thick of trading on Friday. But as it happened, Iran did respond over the weekend, by two drones and dozens of cruise missiles, but none of them resulted in any major casualties. Although market was fearing a lot of fallout, and this, Israel in fact was able to thwart most of their attack. And after the attack, Iran also said the matter was concluded and vowed to strike back if there was a retaliation from Israel once again. Now, if you look at how the analysts are viewing this, that the intent of the attack was to show their capability and not necessarily to escalate. And one should also expect intense global diplomatic pressure to avoid any further escalation, by either party. Though US has vowed its strong support to Israel in its defense, but will not support attack. That is what the news says. So you should see that these attacks, which came rather swiftly, oil did not react much on the upside and even did not break 92 levels on the Brent. So market feels Iran's attack was more symbolic, strike to show that they will respond to attacks, such as one seen on April 1st. Other factor that many are considering is that the bulk of the actors in Middle East and beyond see that any escalation that results in a real threat to oil infrastructure and shipping is not in their own interest. So I think while the situation remains bit uncertain, bit tense, and the uncertainty won't go away in a hurry, I think immediate escalation is not foreseen. So we see markets slowly returning to calmness after the turbulence that was seen on Friday, and that's in fact reflected already in the U.S. Treasury yields that have actually gone up during Asian time today. The 2-year, which had fallen to 4.85 in Friday's trading, actually has gone to 4.91, and similarly even 10-year and 30-year have also moved up. These are actually symbolic of some calmness returning to markets. Even the gold, as we could see on Friday's late evening trading, that after reaching 2,431, gold swiftly came down by nearly $90, and that was actually a combination of buy rumor, sell fact, then take profit by large players, and also some sense that US yields are higher, and there's only a limit up to which you can ignore the higher yields and keep buying gold. Although there are other reasons to buy gold as well, but I think the short-term market was quite overbought. So these are the reasons why some sort of a calmness in the geopolitics perceived in the coming days has helped the markets to return to some calmness. Yes, immediate reaction in the markets was definitely much more. We had the yields falling, as I said earlier, and then the stock market fell quite a bit in the US. All the major indices falling more than 1%. To add to these, negative sentiment was very, very downbeat reports of earnings from major banks like JP Morgan, Citi, and also Wells Fargo on Friday. So the investors were really in a mood to get out of stocks, at least for the time being, and that resulted in the big fall. In fact, in the month of in the last week alone, we have had US losing, Dow losing more than 2%, and then S&P 500 losing about 1.5%. So nothing to threaten the current strong bull trend, which is not giving up so easily. But then there is some bumps that we are, seeing for the rally, either in terms of monetary policy or in geopolitics. Yes, speaking of monetary policy, there is no fresh clues on the US inflation, but more members are still giving mixed views on how US should proceed. But now the focus is clearly on the PCE core inflation that is coming up on 26th of this month, and the expectations are that it could ease. And it's a good thing that oil has not run away beyond the 91, 92, so that can also actually help the sentiment. But yes, Michigan Sentiment Survey showed that the inflation expectations for 1 year forward has risen to 3.1% from 2.9%, and which means that consumers are now slightly worried on that respect. On the currencies, dollar was stronger in the last 2 days by more than 1.5%. That's mainly helped by euro that fell through 1.07, that was holding for a few months. Dollar yen, which broke through 152 and has traded a high of 153.6070 also in today's trading. This is backed by higher US yields and expectation in Europe that they will cut ahead of US as well. Most members in ECB are in favor of cut in June, while US cut may not be earlier than September unless things take a swift turn on the inflation, or if there is a sudden slowdown in the economy that is observed. So the rate differential actually helping the dollar to be strong. Of course, safe haven bids were also there for the dollar on Friday when the war news broke out. As for other currencies, I think Chinese yuan has held up well despite a very, very downbeat export data, falling 7.5% in March. It was expected to be negative, but not as much as this. And in fact, last month it was well in the positive territory. So expectation was that Chinese authorities may let the yuan fall or may let it fall in the coming days. But so far, no signs. And dollar yuan has been holding around 7.26 levels quite comfortably. And yes, coming back to rupee, yes, we did retest the highs once again on Friday. Persistent buying from FIS as well as from oil companies, and sentiment being not so good. Our own stock market was also down about a percent, the major indices. But I think in the offshore trading, well, we traded at 783.60, back today below 83.50, possibly looking at the yuan stability, and also some sort of expectation of relative calmness emerging in the Middle East, and also the domestic macros, which have been quite strong. We had the inflation number that came at 4.85, much below 4.91 that was being expected for March. Core inflation falling to 3.3%. Industrial production was much higher than expected. So overall, Indian macros looking good, not justifying a steep fall in the rupee unless we see very large outflows. But even then, RBI is well armed with a record reserve, which is now at 648 billion. Our focus is now on today's trade data, expected to be once again lower by about 2 billion on the merchandise side. So again, good number for our current account deficit management. And so not seeing immediate threat to rupee, although there is no return to previous low levels on the USD. But yes, we might, based on global negatives, we see a slow move to 83.70 or 84, but nothing as a panic move as far as rupee is concerned.
Thank you, JK. And despite the geopolitical turmoil which has happened during the weekend, as of now, it seems things are returning to calmness. We are seeing some rise in yields in the Asian trading session today morning, especially on the US front. But oil price, the good news has been the oil prices have been capped at around 91, 92. And we are also seeing some stability in the Chinese yuan, which has held up despite not so good trade data. For USD/INR, we did test the highs on Friday. However, currently it is again trading below 83.50. And today's trade data, it is expected that it will be lower by around 2 billion for the merchandise trade. So let's see how all of this pans out, how the geopolitics pan out. So do tune in tomorrow for the latest in the financial markets, as well as any new updates on the geopolitical front. Thanks for listening.